Before we kickstart trade, important to watch out for how the Asian markets are performing as well. They're treading water ahead of this week's US-China trade talks, which begin on October 1. So that is something we'll be keeping an eye out on. The Nikkei lower by about 0.3%. We have the Korean markets also trading around the flat line. The Straits as well as the Taiwanese indices should come up for you on your screen, and both of them are in focus as we speak. The Straits index is mildly in the red as we speak, and the Taiwanese index, actually both of those indices have recovered from lows, currently sitting with gains of about 0.4%. In light of that, we have the SGX Nifty, which is indicating a mildly positive start. Remember, in the last 4 sessions, we've lost almost 400 points on the Nifty, given up 50% of the gains that we saw that accrued just post the finance minister's tax cut announcement. And this comes ahead of, the US-China trade talks on October 10th. The Wall Street did very well on Friday's trading session on the jobs data, Pavitra.
Absolutely. So let's continue talking about Wall Street then. US stocks closed higher on Friday after the Labor Department's monthly employment report came in better than expected, calming fears of a recession. So the Dow Jones rose around 370 odd points. The S&P 500 and Nasdaq also advanced around 1.4% each. The U.S. economy added 136,000 jobs in September, but the unemployment rate, that is the key thing to focus on here, that fell to a 50-year low of just 3.5%. We now have CNBC's Julia Burstein to get us a wrap of all of the action on Wall Street. Julia.
U.S. stocks posting big gains on Friday, though the Dow and S&P were both negative for the week. The Dow adding 372 points, the S&P up 41, and the Nasdaq higher by 110 points. The U.S. adding 136,000 jobs in September, coming in below economists' expectations. Gains were led by professional and business services as well as healthcare, while manufacturing and retail industries showed net losses. The unemployment rate, meanwhile, falling to its lowest level since 1969 at just 3.5%. Microsoft warning today that it has seen significant cyber activity targeting U.S. presidential campaigns from a hacking group that appears to be linked to the Iranian government. The company is saying the group made thousands of attempts to identify consumer email accounts and then attacked more than 200 of those accounts. Reuters reporting that it was President Trump's re-election campaign that was the target of those attacks. And the streaming wars are moving to a new turf, advertising. Disney is banning Netflix ads from all of its TV platforms except ESPN, as the film and television giant gears up to launch its Disney Plus streaming service, which will be ad-free. The news follows a report from the Wall Street Journal that Amazon and Disney are also battling over ad terms. That's the action from the U.S. market. Back to you in Mumbai.
Julia, thanks a lot for taking us through all of that action. But on that note now, here is some opinion from experts on the U.S. jobs data as well as the road ahead for the U.S. economy.
The most important thing to recognize here is the limits to growth. I mean, it's great to see an unemployment rate at 3.5%, the lowest since 1969. But everywhere in this report, you can see that businesses are really finding it hard to find qualified workers. And I think that is having some effect. I'm a little bit more concerned about this. I do think that this, to some extent, reflects still lingering strength from last year. But I think these job numbers will slow as we head towards the end of the year. We've got a supply-side constraint and we've got a demand-side constraint because of the trade war and the impact that's having on business psychology. On wage growth, what I think it says, again, a little bit about this business caution. Businesses are quite capable of drawing a line, even in a tight labor market, saying we will not pay an increase. So I think, what's fascinating is you can have this very tight labor market. Anybody can get a job, but it's much harder to get a raise. And I think that's, that's just a sign of the economy we're dealing with here. But we'll be watching all of this carefully. Whether it's consumer spending or business hiring, either way, I think there is trouble ahead if we don't see more confidence and more certainty around the trade outlook and the overall economic outlook.
We have a very low unemployment rate at this point. We're relatively close to 2% inflation. So the kind of job growth that you would expect if you're trying to keep the unemployment rate basically constant and the inflation rate constant would be in the range of 90 to maybe 115,000. So we're getting to the point where we're getting about the kind of employment growth that I would expect in kind of a stable economy. I think the bigger question is whether it ends up being weaker from here, and that depends importantly on what happens on the consumer side of the economy. I still have an open mind. We still have more data between now and when the meeting actually occurs. I'm going to be quite attentive to what's happening with anything that indicates that the consumer is changing their view. We had an auto report that was reasonably strong. So if we were really worried about the consumer getting very concerned, you wouldn't have thought auto sales would be quite as strong as what we saw. So we'll have to see how the consumer is continuing to react. We'll have to see what's happening on the price side as well. So I think there's still a little bit more data before the meeting. I don't think I should prejudge it at this point. We've already had 2 easings. The easings don't have their impact immediately. Monetary policy currently is accommodative. So in the longer run, we think that a Fed funds rate around 2.5% would be the appropriate long-run federal funds rate. My estimate of potential is around 1.7. That's pretty consistent with what the private sector expects for the last 2 quarters of this year. I think that data that we have is weaker than it was before, but it's actually pretty consistent with getting around a 1.7. If we start getting much slower than that, then that implies a rising unemployment rate, and then we would really want to think about what's happening in the economy. I would say that some of the data that we've gotten over this week's not a complete surprise. So we know that tariffs are having an effect on the economy. We know that the manufacturing sector globally is being impacted by what's happening with trade. So we would expect that exports and manufacturing would be weak, and that's exactly what we're seeing. The bigger question, I think, is does it spill over to areas not directly affected by trade concerns?
All right, so that was about the U.S. markets and the road ahead for the U.S. economy. In fact, the jobs data also impacted markets across the Atlantic. So European markets, they closed higher on Friday after the U.S. jobs report showed employment growing steadily and the jobless rate hitting a 50-year low. That eased some fears of a slowing economy. But economists actually call this jobs data more Goldilocks than anything else, primarily because it was low enough for them to, take note of the Fed perhaps cutting rates, but it was high enough to quell fears of a recession, as a result of which all the frontline European indices ending almost 1% higher, the FTSE actually going 1.1%, outperforming primarily on account of a weakening strength. So weakening sterling. So that's why the exporters in the British index did well.
All right, so that was all of the action from Europe. Let's also take a look at the crude markets now. Oil prices declined on concerns that a slowing global economy could dent oil demand. Here's some opinion from Helima Croft of RBC Capital Markets on the outlook going forward.
We will have to see where we end up in year end in terms of demand growth numbers. People are taking them down. But I think right now we're in a situation where sentiment is really, really driving this market right now. The question is 80 the new 100 in terms of the political risk ceiling? I think we just have to wait and see. I mean, I think the attacks we've seen have been unprecedented from the middle of May. We've had 6 tankers attacked. We've had literally a cruise missile sent into one of the most important energy facilities in the world. And the market is like, 2 weeks later, not a big deal. The question is, if we have more attacks, does that change the psychology of this market? We have to wait and see. I think the fact that Saudi Arabia was so quick to restore the production. I mean, this was a massive outage. 5.7 million barrels taken offline by this really extraordinary combination attack involving cruise missiles and drones. And yet Saudi brought it all back so much quicker than the market anticipated. I think we're probably looking at more disruption. I don't think the Iranians have shown any indication that they're going to back off because they're really seeking sanctions relief. But for now, the market is back focusing on concerns about demand growth slowdown, about a recession.
All right, so that was about the U.S. markets. But the most recent disclosure that Z has made has been the talk of town of VTB Capital getting encumbrance of shares in lieu of loan taken by the SL Group. Puneet Goenka, in an interview to our colleague Nisha Poddar, assured that there is no risk of VTB Capital going ahead and selling Z shares, and the company may actually consider extending the loan term. Here's an excerpt.
Let me clarify that this loan is nothing new. It has been part of the total loan that was declared by us back in January itself of 13,500 crores. That loan amount today stands at 7,000 crores, and both these figures include the VTB debt. The way it is structured is that we have another year for maturity of that loan. We have already in agreement with them that they are not invoking any of these shares, and they're going to work with us through the sale process, where if we pay them certain amount of money, they are even willing to extend this loan for us.
Beyond 1 year, you're saying?
Beyond 1 year, yes.
All right. So here I want to understand, Mr. Goenka, that of course the terms of agreement are between the promoter group as well as VTB Capital. But when we talk about the risk factors for any shareholder in the company, then at least the covenants or the trigger points because of which they may sell ahead of the maturity period. If you can articulate that.
So Nisha, as I just mentioned, that within the next 3 months, if I'm able to conclude part of the sale that we are hoping to do through Z and the infrastructure assets that we have talked about,
Yes.
If part of those proceeds are paid to VTB, they would automatically extend the loan beyond that.
Right.
So I don't see any breach of covenants happening.
Right.
As you can see, even today their cover is well above 1x. So I'm not expecting any breach to happen from their side on this facility at all.
What part of the amount from the proceeds of stake sales and asset sales will have to go to VTB Capital as part of the agreement, as you said?
So we've been negotiating with them on that. We have not come to a precise number yet, but it will be a very small amount compared to the total loan outstanding.
All right. So will it be a top up or will it be the margin cover?
No, it will actually be a reduction in debt.
Reduction in debt.
Yes.
So, all right. So what it means is that from the proceeds, if that 10.7% stake, a part of that is sold, then a part of the funds will go to VTB Capital.
Correct, correct. If you remember correctly, in the Invesco Oppenheimer deal,
Yes.
we had reserved 2% of the 11% for the VTB transaction itself.
All right.
And that is what will go to them towards when the stake sale happens.
All right. Now, as far as the trigger points for their any fire sale is concerned, if at all there is an agreement, if you can elaborate on that, because the current situation is such that the economic slowdown as well as market volatility has also not helped your stock, apart from the uncertainty around the repayment of the lenders.
Sure.
So how do you see this in terms of the trigger points that VTB Capital may have, because that's something which is causing a little bit of uncertainty in the mind of the investor?
So first and foremost, one has to keep in mind that of the 13,500 crores, we've paid almost half of it down to the lenders.
Yes.
That itself has been a significant achievement on our part, and the lenders acknowledge that.
Yes.
And the proof of the pudding is in them giving me the extension
Yes.
beyond the 30th September deadline. The question of breach on account of the VTB loan, in my view, doesn't arise because they are well above 1x cover.
Right.
And within the next 3 months, if we are able to solve this problem, they are willing to extend that to us.
Right.
Let me state here very clearly, then over a period of 12 to 18 months, I am confident that we will retain at least half of the 22% shareholding as promoters of the company.
All right, that was an interesting chat that Puneet Goenka had with Nisha, saying that there's no risk of VTB selling their Z shares. We will keep getting you more of that in-depth interview later on in the show and throughout the day as well. But we have to slip into a short break now. Up next, we'll take you through all of the cues and news you need to know for trade this morning.